Hello, and welcome to Arnerich Massena's fourth quarter MarketCast. As investors, we find that every new year brings a mix of opportunities and challenges. In some years, like 2019, it seems like every investment idea just works. But in other years, such as 2008, it seems that there are very few ideas that can work. Now, as we're headed into 2022, we're seeing some unusual challenges, and these have sparked some investment ideas that we'd like to share. In today's MarketCast, investment advisor Katherine Fox and I will discuss our latest thinking about markets and portfolios going forward. So, now I'll turn it over to Katherine to get started.
Thanks, Bryan. 2021 was the third year in a row of double-digit returns for U.S. large-cap stocks. The S&P 500 index climbed 29% for the year, with 11% of that rise happening in the fourth quarter. But the stock rally was narrow and limited mostly to U.S. large companies, leaving U.S. small cap, international, and emerging markets trailing behind. And for the U.S. dollar and bonds, returns were modest in what has continued to be a relatively stable and low-yielding environment. In 2021, giant U.S. mega caps dominated the global stock market. By the end of the year, the 5 biggest U.S. companies, Microsoft, Apple, Amazon, Google, and Tesla, had grown to the point where they represented over 23% of the S&P 500 index. These giants earned on average 41% last year, compared to 29% for the full S&P 500 index. But by the end of the year, these stocks had become very expensive, with an average price-to-earnings ratio that was 1.8 times that of the full S&P 500 index. We've seen the remarkable upside performance of these large and mega cap stocks, but what's their potential downside? This table shows the historical worst-case drawdowns of various investments over holding periods from 1 month to 5 years. As you can see, large U.S. companies were not an effective safe haven. Instead, intermediate bonds and hedge and diversifying investments performed far better during market downturns. So to guard against these kind of drawdowns, we think it's extremely important to diversify across both growth-oriented and conservative asset classes. Diversification isn't just about risk reduction. Staying diversified can often add to performance, as we'll see in this chart. Here in red are the 3 worst performing stock sectors of 2020: energy, real estate, and financials. But just 1 year later, these 3 money-losing sectors turned around and became the 3 top-performing sectors. So an investor who failed to diversify into these sectors would have missed out on their huge rebound in 2021. Now, looking ahead to the future, what do we think the markets might do next? Over the past few months, we've been seeing 2 warning signs: high stock valuations and high inflation. And while high stock valuations are well known to be a warning sign of possible long-term stock underperformance, our research also shows that peaks in inflation are often a warning sign of possible short-term stock underperformance. For example, in this chart, we show the performance of stocks around the major inflation peaks and troughs of the past 3 decades. Looking below the horizontal 2% line, we can see that when inflation hits a bottom, stocks often do well during the 6 months near the bottom. But looking above the line, when inflation hits a peak, stocks have often underperformed. Given where inflation is now, it looks like we're close to reaching another peak. While this current environment of high stock valuations and high inflation doesn't necessarily mean that stocks will underperform this year, we do think this is a good time to tactically position more conservatively. And now, to further discuss all tactical views, I'll hand it back to Bryan Shipley.
Thank you, Katherine. During the past 3 years, we've seen stock prices rise to record highs, fueled by low interest rates and back-to-back stimulus packages. But now it looks like we may be entering a more difficult period for stocks, one where stimulus and rescue packages may be harder to come by. And this has led us to adjust our tactical views in 2 different ways. First, we're reducing our view on growth-oriented investments to neutral. And second, we're raising our view on conservative investments, such as low-duration bonds, that focus on preserving capital. But as you can see, we're continuing to emphasize hedge and diversifying investments with the potential to provide good risk-adjusted returns. From a big picture perspective, we're moving towards a more neutral risk appetite when it comes to allocating between growth and conservative. And we continue to expect our investment managers to find opportunities to add value within their mandates. In the coming months, we'll continue bringing you new investment ideas. Your advisor will work closely with you on specific opportunities as they become available. We're also very pleased to announce that Arnerich Massena has been named a Real Leaders Top Impact Company for the second year in a row. Real Leaders unveiled its 2022 rankings of top global visionary companies that are making a social and environmental impact, and we're honored to be among this tremendous group. Real Leaders will be hosting a ceremony on February 24th, and you can find out more information and link to the full rankings on Arnerich Massena's blog and social media pages. Thank you for joining us today.